Thanks for joining me today in our discussion about the income-driven repayment programs and give you an analysis of how you select the various repayment options for the federal student loans. My name is Sergio Stavio, and I'm going to hopefully discuss some detail about these programs. I'm recording this during COVID-19, December of 2020. Hopefully this finds you all well and being safe. So let me just get into the analysis. I'm going to give you an overview of some of the details of the program and the various options that you have available for federal student loans. So I kind of classify them in two categories, which are conventionally fully amortized repayment options or the income-driven repayment options. So the conventionally fully amortized, what that means is that over the life of the loan, whether it's 10 years, 25 years, or 30 years, you've paid the loan off in full. So that's typical, of a home mortgage and a lot of other loans. So within the conventionally fully amortized options, you have a 10-year standard, 25-year extended, 30-year consolidated. So unless you tell the loan servicer otherwise, you'll automatically be placed in the 10-year standard. And just to give you a sense of how much that payment would be, if you had $600,000 outstanding, the monthly payment would be $6,600. And that's all after tax money. So on a pre-tax basis, your first $10,000 of pre-tax income would be dedicated to that $6,600 after-tax monthly payment. So certainly a substantial obligation if you do select the 10-year standard. Normally I don't recommend that because so much of your money is being dedicated to student loan payments and you're delaying other financial objectives like practice ownership, home ownership, contribution to retirement accounts, things of that nature that are productive. You also have a 25-year or 30-year repayment. You can see the monthly payment obligations under those terms. I just don't think those are practical. My position is that either you want a 10-year standard payment if the monthly payment is reasonable relative to your income, or you're going to go into one of the income-driven repayment programs. By extending it to 25 or 30 years, your total cost of loan is not acceptable. So with the income-driven repayment programs, your payments are tied to a percentage of your income. The ones that I'll discuss really are focused in on are new income-based repayment, otherwise known as pay-as-you-earn, and revised pay-as-you-earn. Old income-based repayment, or IBR, was the first iteration. I think it was introduced in 2010, and the payment is based on 50% of your discretionary income, and it's just a third higher than new IBR, pay-as-you-earn, or revised pay-as-you-earn. So it's really not a consideration for most borrowers. So really, you're looking at new IBR or revised, otherwise known as pay-as-you-earn or a revised pay-as-you-earn. So those are the two that I would consider for the income-driven repayment program. And again, if your outstanding debt is reasonable, then you might consider the 10-year standard. And I'll go into what I consider to be reasonable. This slide just kind of gives you more detail about the programs, and I wouldn't focus on old IBR because, again, the monthly payments are a third higher than the two other options. So I would consider either new IBR pay-as-you-earn or revised pay-as-you-earn. One of the advantages with revised pay-as-you-earn or repay is that it provides a 50% interest subsidy on any negative amortization, which means interest accrual. Because your payments are so low, it's not sufficient to cover the interest due. And with repay, they provide a 50% interest subsidy. So if you're underpaying the interest by, let's say, $1,000 a month, here you would only be responsible for $500. In new IBR Pay As You Earn, that benefit is not available to you, so you're responsible for the full accrued interest. So advantage Repay in that regard. The disadvantage with Repay are these 2 bullet points. So the spouse's income is always considered regardless of filing status. So if you filed separately for whatever reason, your spouse's income would still be considered. And you know, for those spouses who don't have student loans, I probably wouldn't recommend that you be and they have income. I probably wouldn't recommend that you have be in Repay, maybe Pay. But if your spouse does have student loans, then it may be in your best interest to both be in Repay. The other disadvantage with Repay is that it's a 25-year repayment period, whereas Pay is a 20-year repayment period. Another advantage here with Pay, and it's not noted in these bullet points, is that with Pay As You Earn or new IBR, you could file separately to exclude your spouse's income. So if your spouse doesn't have student loans, then you could file separately, exclude the spouse's income, and they would only use your income, the borrower's income, to determine your monthly payment. And that could be a significant advantage. So something to consider. But let me get into kind of a general rule of thumb as to how do you select the various repayment plans. Again, I'm probably wouldn't even consider a 25-year extended repayment or a 30-year consolidated payment. The 3 programs that I would look at would be the 10-year standard payment amount, new IBR Pay As You Earn as the second one, and the third one would be revised Pay As You Earn or Pay. Now, so of those 3, how do you kind of narrow it down? So my general rule of thumb is that you should be in one of the income-driven repayment programs if your student debt to income ratio is 2 times or greater. So, for example, if you have $500,000 outstanding in student debt and your income is $200,000, then I would suggest that you be in one of the income-driven repayment programs. Now, if you're kind of in a 1-to-1 ratio, so you have $200,000 outstanding in student debt and $200,000 in income, then I would recommend a more aggressive strategy with your student loan payments. You can be either in a 10-year standard, or you could refinance your loans to an outside company. And don't conflate consolidation with refinancing. Consolidation is a process where your loans stay with the federal government and therefore eligible for the income-driven repayment programs and all the federal options. When you refinance, you leave the federal system and you go to a private lender. And you know, it could be First Republic Bank, SoFi or SoFi, Common Bond, Laurel Road. There are quite a few private refinance lenders, but they're not eligible for any of the income-driven repayment programs. But again, if your student debt to income ratio is closer to 1-to-1 or less, then you might consider refinancing in order to secure a lower interest rate. One of the nice benefits in this current environment in 2020 is that interest rates are historically low. So you can capture a historically low rate, again, if your debt to, student debt to income ratio is closer to 1-to-1. But otherwise, if you're closer to 2-to-1 or greater, then you want to be in an income-driven repayment program. So, you know, that second item, why do you want to be in a, why this general rule, is because if your ratio is 2-to-1 or greater, so much of your income would be dedicated to your student loan payment in a more fully amortized conventional payment, that it would delay some other productive financial opportunities. What I mean by that is, practice ownership, contributing to retirement accounts, home ownership. probably the best way to increase your, with regards to dentists, to increase your income is by practice ownership. So if you're delaying that practice ownership opportunity because you prioritize your student loans, then you are delaying greater income opportunities. So, I would suggest being an income-driven repayment program in order to maximize your income potential as a practice owner. So kind of my take, my general rule of thumb on how to approach this. And this is just to highlight that point. So assuming two incomes, these would be your, and this is based on 2020 tax tables, your tax liability. So federal income tax about $20,000 here and $35,000 at an income level of 180. Your Social Security, $7,400 here, $8,500 there. Medicare, $1,700 and $2,600. California state income tax, and I obviously assume you're living in the state of California, $7,900 and $13,500. So total tax obligations on $120,000 comes out to about $37,000 or 30.8%. So you're dedicating, or you're paying 31 cents on the dollar for each dollar of income. Here, your total tax liability comes out to about $59,000 or about 33%. So your after-tax income comes out to $83,000 and about $121 respectively. And if you're in a 10-year standard payment on $500,000 outstanding at 7% interest rate, your annual payments would be about $70,000. So that would leave approximately $13,000 on a gross annual income of $120,000 after tax after student loan payments. Again, leaves you $13,000. Here, $51,000. And then from here, you have to take in consideration all your other obligations. So malpractice insurance, for a lot of associates, particularly in California, you may not have health insurance. So you have to pay your own health insurance out of pocket. Disability insurance, I would recommend disability insurance. Your greatest asset is your ability to earn income. If that's compromised, then you're going to have to have a means to have another source of income, disability insurance, own occupation, disability insurance, auto insurance. Just from the insurance perspective, you might, those total premiums might be close to that $13,000. So what's left for rent, food, utilities, those things? Not much. Here again, once you subtract out all the necessary insurances, you have a very modest amount remaining. So in both cases, I would probably recommend that you're in an income-driven repayment program with a relatively high payment amount. So I'll get into this spreadsheet now to give you a better sense of what this means from that perspective. So this is this spreadsheet I designed. Here's my contact information if you want to reach out to me. And here I'm assuming $500,000 at an average interest rate of 6.5 with one in family. So as the family size increases and all other variables will remain the same, then the monthly payment actually drops. The effective rate here, this is for the tax bomb. So this is the tax rate I'm assuming based on the taxable forgiveness of any remaining debt after the repayment period, an inflation rate, as well as the investment return. And this is used for analyzing how much you should invest based on, say, a 6% return. I can change this variable. And I can change this. We could say $600,000, and we'll see some of these numbers change right here as well as right here primarily. So if you have a higher debt balance, it may be a greater benefit to you to be in a income-driven repayment option. But I'm going to revert it back to $500,000, and I'm assuming this income stream. And some people have objections to this income stream, but take into consideration the ADA and the Bureau of Labor Statistics most recently said the average dentist, whether it's a first-year grad or someone who's been practicing, for 30 years, and that includes practice owners as well, who are GPs, their average income is about $190,000. And that's plateaued, and it's been flat for a number of years now. We haven't seen an increase in that $190,000. And given the level of insurance saturation throughout the profession, I would imagine there's going to be downward influence in terms of income potential for dentists. So I think these are relatively accurate, but I can change them as we go. The reason I put 0 in 2019, what happens is with these income-driven repayment programs, they look back at the prior year for income purposes. So if you graduated in, say, May of 2020, typically they'll look at your 2019 income, and the expectation is that you had no income, and as a result, you had a 0 here. Again, if you graduated May, June of 2020, you may not, given the unique nature of this year, probably even lower than this. But let's just assume that you started practicing in September and you practiced for about 4 months. Then it increases from that point forward. So this kind of gives you a comparison about the various repayment programs, whether it's these 3, which are the income-driven repayment programs, and 2 out of the 3 more conventionally fully amortized payments. So again, unless you tell the loan servicer otherwise, you automatically get placed into a 10-year standard. So at this outstanding balance, at this interest rate, over the life of 10 years, 120 payments, you would have paid a total of $681,000. Again, because it's fully amortized, the loan is paid off in full at the end of 10 years. There's no balance forgiven. As a result, there's no tax bond to be concerned with. But again, your nominal cost of loan is $681,000. The effective interest rate is 6.5% because there is no forgiveness. And here, what I'm trying to do, and these 2 columns are really, truly apples to apples comparison between the various programs. In the net present value, NPV, cost of the loan, what it does is it discounts all those payments that you made, in this case over 10 years, and based on the inflation rate here, it brings it to a present value for comparison purposes. So the present value, given a 2% inflation rate, is about $617,000. So again, I think these 2 columns are the best apple-to-apple comparison between the various options. And just to give you a sense of the payments, again, the monthly payment of $500,000 at 6.5%. The monthly payment amount is at about almost $5,700 per month. So total paid would be $681,000. So if you had an original balance of $500,000, then the interest that you paid over that 10 years is $181,000. So, with, let's say, pay-as-you-earn or new IBR, the total payments are based on this income stream over a 20-year period. So your total payments based on income came out to $265,000, $266,000. But you know what? I made a change, and let me correct this. I noticed that's not correct. Let me see if I can revert back. So, okay, now it's correct. So, um, the balance forgiven is $847,000. And if I assume a 37.5% effective tax rate, that means I have a estimated tax bomb of $317,000, which means that I would have to make a lump sum payment of $317,646 to the IRS come, let's say, April 2041. Again, a lump sum payment. So one of the concerns I have with the income-driven repayment programs is the estimated tax bomb. Are you properly preparing yourself for this lump sum payment due 20 years in the future for those individuals who are in pay or UIBR? Now, the nominal cost of the loan is not the most accurate because it just tells you how much you paid over the life of the loan to combine this amount, the estimated tax bomb, plus what you paid. So in this case, it's $583,000. And the 10-year standard, that's not correct. Did I change that? Oh, you know what? I did change that. Let me put that back to do a better comparison. Okay, that's correct. Okay, so here the nominal cost of the loan is $597,000. The nominal cost of the 10-year standard is about $681,000. So what? There's an $80,000 difference between the two. So it's still in your best interest because this is a 20-year repayment period. So the monthly payments are much more manageable. And I'll just give you a little look at it before I go back to that page. So even at, let's say, almost $200,000, your monthly payment's only $1,450. So it's certainly reasonable, and that was the intent of these programs, is to make the payments reasonable, where the 10-year is almost $5,700. So at $200,000 annual income, resulting in a payment of $1,450, it's very reasonable from that perspective. Now, in this column, what I'm trying to identify is how much you should invest over the life of the loan on a monthly basis in order to have sufficient funds to cover this tax liability. So if you're able to invest $861, generating an annual return of about 6%, then you'll have sufficient funds in this account to pay for this lump sum payment come due 20 years. So here's where, again, the apples to apples comparison happens. In this scenario, assuming this income, your effective interest rate is a negative 56 basis points, or negative 56/100ths of a percentage point, meaning that the total amount you paid is less than the amount that went into repayment. So that results in a negative rate. And here, again, the net present value comes out to $432,000. So as I mentioned before, the net present value discounts all your payments, including the tax bomb, in this case $331,000, $32,000, and discount them to the present day based on this inflation rate. So if I move this inflation rate higher, let's see what those numbers do. They actually drop. So if you have an inflation rate of 5%, then this value drops to about $269,000. In this situation, inflation is your friend. But let's assume that the last 5 or 6 years inflation has hovered around 2%. So I'll assume that's going to be the case going forward. So in this case, the net present value is $432,000 compared to the 10-year standard of $617,000. So that's what, $185,000 difference between the two. So significant. And again, you know, with these payments, the intent was to make them modest. So even at $218,000 of annual income, your monthly payment is only about $1,600. Keep in mind that you do have to make, you know, investment. And here I'm saying $861. So your total commitment comes out to about what, $2,450, let's say, based on the $1,600 here and the investment of $861. So your total commitment to your student loan payments comes out to, say, $2,450. Again, with the 10-year, you're looking at $5,600, $5,700. So that's, you know, $3,200 per month in additional cash flow that you have, you know, at that income level here that you wouldn't otherwise have. So that allows for, that additional $3,250 allows for additional, you know, other investment opportunities that you would otherwise delay. So certainly a consideration. And just to give you some other sense, say that you're much more conservative in your investment strategy, and you're looking at money market CDs, bonds, which have little risk, but as a result, you're generating a much more modest return. So let's change this from 6 to 2.5, and let's see what these investment levels change. So here it increases to $1,279, and it causes this effective interest rate to jump up to 1.4. So it's, you know, almost 90 basis points or 9/10 of a point higher. This investment at a 6% return was at, I think it was 861. But let's say you're more aggressive, and you got, over the life of the loan, you got a 9% return. So at a 9% return, this investment, monthly investment, drops down to about $600. And here you're at a negative almost 2%. So your investment strategy certainly does have an effect on how much you need to invest. But again, let's look at this income stream from 1 to 20. Again, paid, new IBR is a 20-year repayment period. These are the monthly payments. Now the concern, I mean, one thing that you need to be aware of, as I mentioned before, with the income-driven repayment programs, your payments aren't sufficient to cover the interest due. And that's referred to as negative amortization. So in this first year, because you're not making any payments on a $500,000 balance at 6.5%, you've accrued $32,500 of interest. So this is the annual amount of interest that's accruing. This is a cumulative total. So after 20 years, you would have accrued almost $385,000 of interest. You would not have paid anything towards the principal. So your principal balance still remains at $500,000. So your total amount of principal interest at the end of 20 years is that $885,000. So assuming that the tax rate is at 37.5%, then you would have an estimated tax liability of $332,000. So again, based on this estimated tax liability, I'm saying that you should save $861 per month, assuming a 6% interest rate. So at the end of that 20 years, assuming that you made 240 monthly investments at $861,000, generated a 6% return, your total investment value would be about $398,000. And the reason that you want this to be higher than the estimated tax liability is because the expectation is you'll be investing in taxable accounts. So there's a tax associated with this investment. You probably don't want to put it in a retirement account because retirement accounts are subject to a 10% penalty if you withdraw before 59.5. So most of you will, you know, reach the end of the 20-year period probably by your mid to late 40s. So if you do put in a taxable account, then you're subject to a 10% penalty. Then you want to avoid that. You probably want to put it in a taxable account for that. And I do account for the taxable nature of this investment in my spreadsheet, so it's sufficient to cover that amount due. So the total cost of the loan is the combination of all your monthly payments, or annual payments based on your income. So that came out to about $265,500, plus your investment over that 20-year or 240 months period at at 861. Then that total comes out to about $472,000, resulting in that negative effective interest rate of 56 100ths, or negative 56 basis points. So your cost of your loan was about $472, and your total principal balance was $500,000. So you've underpaid that principal balance by $28,000. And again, one of I think the misnomers, particularly now, where the refi rates for private refinances outside the federal systems are relatively low. You can get somewhere maybe 3. If your debt to income ratio is closer to 1 to 1, yeah, that's a consideration. But the misnomer here is that you're paying this stated rate, what's referred to as a stated rate of 6.5%. You're not. Because you're having so much forgiven, the effective interest rate on these loans drops dramatically. So why would you want to refinance to a private market, not be eligible for any of these income-driven repayment programs, and get a rate of 3%, where in fact your interest rate might be in the income-driven repayment programs might even be lower. And in this example, I'm saying he's paying an effective, or she is paying an effective interest rate of minus 56 basis points. So I just think a lot of borrowers are misinformed about refinancing opportunities. But again, every individual circumstances are different. If you want to discuss this, certainly reach out to me. We can schedule an appointment to analyze your specific circumstances. But that's a general overview of this process. You need to manage your repayment options with due diligence and the appropriate knowledge. And if you don't feel comfortable, again, certainly reach out to me. We can do an analysis of your student loan portfolio to recommend a specific strategy. And if that strategy, and during that analysis, we'll go over this process with you. So again, my name is Sergio Estavillo. You're welcome to contact me through these various means. Stay safe. Again, I'm doing this in December of 2020, so I wish you a prosperous, healthy 2021. Let me know if I can be of assistance. Thank you. Bye-bye.